9, that is the exact number of FOMC members out of 18 who just projected an unexpected interest rate increase. So, is a rate hike actually back on the table for 2026?
Hello, everyone. Welcome back to AI Market News. Today, we're unpacking a massive, incredibly hawkish shift delivered by the new Fed chair, Kevin Warsh. It's a move that has pretty much completely upended global market expectations.
In a really stark departure from the Powell era, Warsh was incredibly blunt in his initial communication. He stated, "The Fed will deliver price stability. The commitment to deliver is strong, unanimous, and unambiguous." And that's an important message we've missed for 5 years. Well, this implicit admission that the Fed missed its core mandate is, frankly, a historical pivot. It signals a completely new, direct communication style that is entirely focused on strict inflation control. This policy shock changed everything almost overnight. While the rate was held steady at 3.50 to 3.75%, the median forecast moved up, and the previous easing bias was just entirely removed from the official statement. Based on available data, a December rate hike is now fully priced in by the markets. To understand why this matters for all of us, we have to remember that a hawkish shift means the central bank intends to raise interest rates to deliberately cool down the broader economy and aggressively fight inflation.
Naturally, equity markets reacted instantly. As all of us can see in the chart, the S&P 500, S&P500, dropped 1.21% in a very widespread sell-off. The underlying mechanism here is actually quite straightforward. Higher interest rates make borrowing much more expensive for companies, which directly reduces their corporate profits and, in turn, drives down stock valuations across the board.
Now, looking at the Dow Jones daily chart, we see a broad 507-point drop, primarily dragged down by technology stocks. However, it's absolutely crucial to note that financials, like JP Morgan, actually closed higher. So why did this happen? Well, because higher interest rates mean wider profit margins on the loans that banks issue, making them a rare winner in this high-rate environment.
Moving over to commodities, the graph shows gold dropping significantly. It fell over 2% as the 2-year Treasury yield hit 4.21%. Because gold doesn't pay any interest or dividends, higher yields on government bonds make non-yielding assets like gold much less attractive to hold for investors who are looking for guaranteed returns.
Shifting our focus to currency markets, the USDJPY, dollar-yen, surged past the critical 160.74 level, hitting a 52-week high. The reason for this specific price action is highly fundamental. Capital naturally flows toward currencies that offer higher interest rates. With the US signaling rate hikes, global capital flows straight into the dollar, strengthening it while simultaneously weakening the yen. And this brings all of us right into the danger zone for intervention. Finance Minister Katayama has previously warned of appropriate action at these exact levels. However, if the Ministry of Finance, Zaimusho, intervenes without a fundamental shift in the underlying economic data, the effect is usually only a temporary strengthening of the yen, before a quick reversal right back to the dollar. Of course, this complex environment is directly impacting local Japanese equities. Looking at the Nikkei 225, Nikkei, we can see investors are trying to carefully navigate the dual pressures of a weakening currency, which can temporarily help exporters, against the severe headwind of a shifting U.S. macroeconomic policy that threatens overall global growth. But there is one potential silver lining for the markets right now, and that's oil. WTI Crude, or WTI Genyu, has fallen below the $80 mark to $78.66. Falling oil prices are critical because they reduce transportation and manufacturing costs globally, and that ultimately cools overall consumer inflation from the supply side. According to current market information, this drop in oil creates a truly fascinating base case for all of us to watch. If oil sustains these lower levels, upcoming consumer price readings could drop sharply. And if inflation falls simply due to cheap energy, well, the projected Fed rate hikes become much harder to justify, potentially saving the current market rally. Checking the economic calendar, today's U.S. trading session at 9:30 a.m. ET features high volatility quadruple witching, which is where multiple derivative contracts expire simultaneously. We also have weekly jobless claims. A spike in jobless claims could really test the Fed's strong labor market narrative. Also keep in mind, U.S. markets will be completely closed tomorrow for the Juneteenth holiday. But the ultimate test actually arrives next week. The May PCE, or Personal Consumption Expenditures data, releasing on June 25th, is the Fed's preferred inflation gauge.
This print will show all of us whether falling oil prices are translating into the actual disinflation the Fed needs to abandon their projected rate hike.
So, we are left with a critical question to ponder. Will upcoming inflation data support Warsh's hawkish stance, or will falling oil prices swoop in and save the rally? Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by Notebook LM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.